all about your mentality before you start investing. And to be honest, I think this is one of the most difficult things for people to understand and to achieve, to take your emotions out of it. So this is something as well that you can get to yourself by education, like read articles, listen podcasts, look at long-term results of Warren Buffett, look at long-term results of famous economists, and based on that have confidence in the market performance over a long period of time. Actually, the answer to that might be a little bit boring. The people who achieve long-term results, they're the most consistent ones. So they might be the ones that set up their investment pre-recorded already, so they do recurring investing. So they might have said, like, every month on the first of the month I allocate a certain percentage of my salary to my portfolio. So, and that's for the ones that can afford, of course, the costs, because with investing certain costs are involved. So if you invest a lower amount on a monthly basis, you might do it per quarter, per half year, per year to reduce the cost by making a one-term investment rather than spreading it out over a long period of time. Next to that, they are the ones that are looking as well to reinvest, for example, the dividends that they get on their stocks. So whatever they earn from the portfolio, they make sure it stays in the portfolio. This way, the compounding starts working as well. So after 1 year, 2 years, 3 years, you're actually not only earning anymore what you're investing in the interest, but it's interest on interest on interest. So then your long-term, your results get even better and better. And next to that, they're aware of the costs, of course, what I said before already. They diversify their portfolio, so not to invest only in one product or one sector or one market. They will look at the investment market and they say, okay, 30% I allocate here, 30% I allocate there. And later on in their life as well, they might make an adjustment to the portfolio to be a little bit less in stocks, a little bit more in bonds to reduce the security towards the end of their investment journey. When you invest, you really invest in the value of a certain stock, of a certain product that it represents. So you believe in it. You think on long term that they're gonna perform in a certain manner. When you speculate, it's a short-term game. So you think on the short term, you might be able to make a certain profit or gain a certain interest on the stock. And often you need leverage for this as well, because otherwise, if you want to make short-term profits, you have to invest with a very large amount. And by using leverage, you're actually able to make a short-term profit. The worst thing, in my opinion, of course, I cannot give financial advice to people, is but to doubt between the two. So let's say you start building a long-term portfolio, and then after a month or 2 months, you think, okay, my portfolio is not going where I want it to go, and then you decide, oh, I see an opportunity here, I'm going to sell my long-term, invest short-term, close this one again, go back to long term, because then you're in between the two types of portfolios, and then it becomes gambling because you're trying to time the market instead of focusing on being the time in the market. I think it's one of the key roles. If you look at the current economic situation in the world, if you look at the US, you look at Europe, you look at Middle East, if you are focused in one industry or one market, one sector, it will give you a lot of volatility within your portfolio. So you will not be able to observe certain blows. So if you look at products, those ETFs already, like inside of those kind of products, it's already diversified, but still an ETF might be focused only on the S&P 500. Diversifying is not just by saying, okay, I do the ETF because it has 500 stocks in there, but diversifying means as well looking geographically. If I'm gonna diversify maybe with a worldwide ETF to add it as well. I would say for a long-term investor that is not diversifying, that they're building a risk into their portfolio. I would say it's the mindset that you bring yourself before you start investing. So it's not when the volatility happens. So it's not when a stock rises or a stock drops. It's already what you put in your mind beforehand. Because if you look at the S&P 500 in the last 20 years and you zoom out, you see that the graph goes in one line almost up. But if you zoom in and you look month by month, it will go up, it will go down, up and down. And if you let yourself be influenced by those movements, you actually harm your long-term results more than actually you're gonna make any profits of this. So it's all about your mentality before you start investing. And to be honest, I think this is one of the most difficult things for people to understand and to achieve, to take your emotions out of it. So this is something as well that you can get to yourself by education, like read articles, listen podcasts, look at long-term results of Warren Buffett, look at long-term results of famous economists, and based on that have confidence in the market performance over a long period of time. First of all, you have to understand the product you're investing in. So if you invest in a certain company, understand what does the company stand for? What is their long-term vision? What is the liquidity in the product itself? Is it a product that is going to evolve in the market in the future years? I'm talking about single stocks at the moment. Like if you have an ETF, you cannot really investigate every single stock in an ETF, for example, because there's 500 in them. So maybe the first 10, look into them, understand in the next 10, 15 years, are they still going to be important in the market? Are they going to bring something that's going to bring value to the day-to-day life of every single person? The next one is your mindset and your goals. So am I investing for 10 years, 20 years, 30 years? Based on that, you decide what kind of portfolio you're going to build up. And the third one, in my opinion, is understanding the pricing and the cost of investing. So to understand like how much does it cost me to buy a certain stock. So spread your investment maybe over a longer period of time. How much does it cost me to convert money, for example? Because I deposit in euros as a European, I have to convert to dollars. If I do this on a monthly basis over a period of 30 years, this might harm my end results. So you have to understand the products, have a certain mindset, and next to that, make sure that you have an understanding of all the additional costs. So my first question would be, like I don't expect an answer, but my first question with that person would be, how old is that person? If that person is 18 years old or 20 years old, your horizon, of course, even if you say 10, 20 years, but your horizon is actually maybe 40, maybe actually 50 years. So if that is your horizon, then you can start investing in something more targeted. So you can, for example, do S&P 500, focus on the tech industry, because we can understand in the past 30 years of the results that there's a reasonable expectation that it will perform at a certain percentage over a period of time. If you are, let's say, 50 years old and you look for 10, 15 years or 20 years, then you have to think a little bit more about the volatility that might happen at the end of the 10 years or 15 years. So then I would suggest more, okay, still ETFs, but diversify your ETFs a little bit more. So maybe have the S&P 500, have a worldwide ETF, but as well, as more you get towards the end of your investment career probably, insert a little bit more bonds into the portfolio, because the bonds have a stable interest, a stable profit that you're gonna make on those. And the way Maxim can help is by education, by having webinars, by having partnerships, by providing people access to information based on what they can make certain decisions. And within our platform, we have news feeds. We have different tools for how you can find the best ETF for you, how you can find the best bond for you. The different platforms that we offer, of course, you have the desktop-based platform, but you have as well the mobile, so you can trade on the go, different age groups, different experience of investing. And next to that, one of the most important things long-term as well is, of course, is the pricing. Like the pricing that you pay for an investment, that really tallies up towards the end of a long 10, 20 years period of time.